Oh, hey there guys, Sam Ponte, Logic Property Group. Hope you're all well, hope you're all at home, staying safe and healthy. We've just noticed a huge shift in the financial world due to the huge volatility in the share market. We're noticing a lot of investors, experiencing paper losses of 10, 15, sometimes 20%. So we're noticing a massive shift in where funds are actually moving through different asset classes. And a lot of them are coming out of the share market due to the volatility that people can't stomach. Unfortunately, they're not looking at cash or investing into defensive assets. Reason being is the cash rate is at an all-time low, and your 0.5 or your 1% return on your cash is just going to be eaten up with inflation. Therefore, your money is actually going backwards. What we're noticing is a big shift of a lot of that money flowing into residential property. The reason why it's flowing into residential property and it's now looked at as a safe haven is because residential property, when you look at the statistics and the stats of all the different downturns and crises we've had in history of the property market, you notice that yes, property does decline in value. It's not as nearly hit as hard as what generally the share market is hit, and it tends to bounce back a lot quicker than all the other asset classes. The reason for a lot of money flowing into the residential market is for the long-term capital growth, but more importantly today is the strong rental yield. Depending on the strategy that you're looking for, residential property yields start at about 4%. Depending on the strategy, the capital city, it may be as high as 6% when you look at some dual key income strategies for your residential property portfolio. So whilst these people are moving out of the share market into the residential property market, securing that 4 to 6% rental yield, they've also got a long-term positive view looking at capital growth for that particular city, suburb, or that particular property itself. Also, I want to run over a couple of numbers. Over the past 50 years, we've noticed up to now, 2020, residential property in Australia has always been the most preferred asset class for Australians to invest in, and always looked at as more of a safe haven also. At the moment, we have $7.5 trillion invested in the residential property market. We've got $2.7 trillion invested into superannuation, and we've got $1.7 billion invested into the share market. So based off those numbers, it's quite clear that residential property is more of a safe haven and the most preferred asset class for the everyday Australian people. Hope you enjoyed the video. Please share it with friends, family, colleagues, people that you think would be interested in some sort of education such as this, and getting a little bit more of an understanding about how money flows and different asset classes and what it means to them. Please send it to all of your friends. I look forward to speaking with you soon. See ya.